Ever feel like financial bubbles are just about losing money? Today, I'm going to flip that idea. Stick around, and I might convince you that these bubbles, while definitely causing pain for us investors, often leave behind the very infrastructure and innovations that shape our future. Sound crazy? Let's talk about the biggest gamble in business right now: artificial intelligence, or AI. It's everywhere, from your social media feed to Wall Street predictions. But here's the catch. Despite the AI hype, actual adoption across US businesses is still limited. This gap between expectation and reality is concerning. Think back to late 2022 when OpenAI launched ChatGPT, fastest tech debut ever. Investors piled into AI companies like Nvidia and Microsoft. The sector's booming, with over $1.4 trillion projected for artificial intelligence data centers by 2027. Hey money explorers, welcome to Money Made Easy, the paradox. While the market's obsessed with AI, most US companies aren't using it extensively in their core operations. Many AI startups aren't profitable, and the energy costs to run these models are insane, raising serious questions about long-term sustainability. A major concern: AI models need tons of high-quality data to improve. And some studies suggest we might be facing a data bottleneck sooner than we think. Meanwhile, US companies are burning billions in this AI race, and the underlying economics don't always add up. Consider ChatGPT reportedly losing nearly $1 million daily. Then comes China, with its DeepSeek model and other cheaper AI alternatives, creating significant competitive pressure and impacting the once seemingly untouchable valuations of AI stocks like Nvidia. The big question for every US investor: is artificial intelligence a bubble ready to burst, potentially triggering a wider market correction? To answer that, let's define a bubble. It's when asset prices become significantly detached from their real intrinsic value, driven primarily by excessive speculation and irrational expectations of future growth. A classic and painful example for many US investors is the dot-com bubble of the early 2000s. Back then, countless companies with flimsy business plans and no clear path to profitability saw their valuations skyrocket, simply because they had an internet presence. Financial history, both here in the US and globally, is full of these cautionary tales where enthusiasm completely overshadowed fundamental analysis. That's precisely why so many seasoned US investors and market commentators are currently drawing parallels and sounding alarm bells, comparing the intense excitement surrounding the artificial intelligence market to the speculative excesses of the dot-com bubble. But are these two periods truly mirror images of each other? We need to delve deeper to understand the critical distinctions. Flashback to the US in the late 90s. The commercial internet arrives and changes everything. User-friendly browsers like Mosaic opened up the web to the masses. Online traffic exploded, creating a fertile ground for new businesses. E-commerce pioneers like Amazon, early search engines, and nascent social media platforms began to emerge. The initial public offering of Netscape in 1995 was a watershed moment, igniting a speculative frenzy around internet-related stocks. Any startup with a "com" in its name seemed to attract massive investment, regardless of its actual revenue or business viability. This led to a period of unprecedented and often reckless spending by these fledgling companies. The Nasdaq, the main US index for technology stocks, doubled in value in 1999 alone, an unsustainable rate of growth. The bubble ultimately burst in March 2000, leading to a severe market crash and the demise of numerous overvalued companies. However, amidst the wreckage, companies with genuine innovation and solid business models, like the aforementioned Amazon and Google, not only survived but thrived, becoming the tech behemoths we know today. Now, let's return to the present and the artificial intelligence landscape. While there are certainly echoes of the dot-com bubble in the current AI hype, there are also crucial differences. Algorithms designed to detect speculative behavior in the US tech sector have indeed raised some red flags concerning the rapid appreciation of certain AI stocks. However, prior to the emergence of more competitive open-source AI models like China's DeepSeek, the high valuations of leading AI companies could to some extent be justified by their significant technological lead and the substantial barriers to entry in this complex field. Developing cutting-edge AI. models, and building the massive computing infrastructure required immense capital and specialized expertise, creating a significant moat around these early leaders. But the rise of more accessible and cost-effective AI alternatives is beginning to erode these barriers, introducing a new level of competition. While this increased competition might put downward pressure on the valuations of some AI model providers, it could also lead to wider adoption of artificial intelligence across various industries, potentially benefiting companies providing the underlying computing infrastructure like NVIDIA and the major cloud platforms. This complex dynamic reminds me of the concept of the rot economy, a term coined by tech critic Ed Zitron, which describes a business environment focused on relentless growth metrics over genuine product improvement or long-term sustainability. Are we seeing elements of this in the artificial intelligence sector? The immense pressure to demonstrate rapid progress and attract further investment might be overshadowing the practical challenges and the immense energy costs associated with scaling AI. The market has poured vast sums into AI companies, many of which are still in the pre-profit stage. The fundamental question remains: what happens when the market's patience wears thin? Or when the promised widespread economic transformation driven by artificial intelligence doesn't materialize as quickly as anticipated? Many analysts are bracing for a significant correction in AI stock valuations, potentially mirroring the sharp downturn experienced after the dot-com bubble burst. However, it's crucial to remember the longer-term perspective. Even after the painful dot-com bubble imploded, the internet itself didn't disappear. In fact, it became the foundational technology of the 21st century, driving unprecedented innovation and economic growth across the US and the world. Similarly, even if we do witness a significant cooling off in the AI market, the underlying technological advancements and the potential of artificial intelligence to transform various aspects of our lives and economy are undeniable. Just as the railway mania of the 19th century and the dot-com boom of the late 20th century left behind crucial infrastructure despite the speculative excesses, the current AI frenzy could very well accelerate the development of more powerful neural networks, more efficient data centers, and novel digital infrastructures that will be critical for future economic growth and innovation in the US and globally. Thanks for watching. Share your thoughts on the potential AI bubble and its long-term impact in the comments below. Subscribe to Money Made Easy for more insights into the world of finance and technology. Happy investing. Please remember, the information shared on Money Made Easy is for educational and informational purposes only. It is based on general financial principles and the creator's understanding and experience. This content should not be considered as financial advice.